So you figured out how to buy an ETF, maybe you've even picked out a few good ones. That's awesome. But, and this is a big but, if you're just randomly buying assets you like, your portfolio can get really messy really fast. What you actually need is a strategy, a real plan you can stick to month after month. Take a look at your own portfolio. Does this feel a little familiar? You've got a little bit of this over here, a little of that over there, all good companies, all good funds. But it doesn't quite feel like it's working together, right? If that sounds like you, trust me, you are not alone. This reminds me of a story about a friend of mine. We're going to call him Maverick. He'd just gotten a promotion, had some extra cash, and he was so excited to finally start investing. And look, he did everything right. He learned about ETFs, he compared different brokerages, he made his first trades. But here's the thing. Enthusiasm without a plan, well, it can lead you to some pretty interesting places. Let's just follow Maverick's journey for a second. He starts big with a nice investment in the S&P 500 and some tech funds. Okay, great start. But then in month 2, his developer buddies convince him that tech is absolutely unstoppable, so he doubles down on QQQ. By month 3, he's seen a bunch of videos saying VOO and IVV are the best S&P funds, so he buys those too. And then it's all about dividends. You see the pattern here? He's just chasing whatever sounds hot at that exact moment. And here's where he ended up. After a full year of investing, 70% of his portfolio was in funds that all track the exact same thing, the S&P 500. He thought he was diversifying, right? But what he was actually doing was just buying the same handful of stocks over and over again, just in different wrappers. So here's the real problem. It's the total mismatch. Maverick in real life is the wild one. He's the guy who builds the ramp and then tests it himself before anyone else gets a chance. He commits first and just figures it out midair. But his portfolio, it was steady, slow, completely passive. He was getting so frustrated, and it's no wonder why. His investments didn't reflect who he was at all. And that brings us to the solution, a defined portfolio allocation. This isn't just a shopping list of stocks to buy. Think of it as your personal blueprint for investing. It's a clear, thought-out plan that prevents that kind of sporadic, emotion-driven buying and makes sure your money is actually aligned with your goals and, just as importantly, with your personality. Okay, so how do you actually build one of these? Let's dive into our first model. We'll call this one Set and Forget, and it is absolutely perfect for the investor who just values simplicity above everything else. It really doesn't get much simpler or cleaner than this. 90% of your investment goes into one single, high-quality, reliable ETF. The other 10%, you keep that as dry powder. It's basically just cash on the sidelines, ready for you to deploy when a really great opportunity comes along. And you can just keep it in a high-yield savings account or a money market fund, so it's still earning you something while it waits. Now, you might be thinking, can I do this with any ETF? And, well, technically, yes. But for this strategy to really work over the long term, you want to focus on broad, diversified funds. Think total U.S. market ETFs like VTI, or those broad S&P 500 trackers like VOO or SPYM. This is probably not the place for those trendy single-sector funds. You want a rock-solid foundation. So who is this for? Well, it is definitely not for Maverick. This is for the purist. This is the person who wants to build wealth consistently, but they don't want investing to become their second job. They value a simple, reliable, proven approach, and they trust that time in the market is their greatest asset. Okay, that makes sense. But what if you want a little more diversification? What if putting 90% of your money into a single fund just feels a little too concentrated for you? Well, that brings us right to our second model. This is the balanced approach. The 3 buckets. Here, you divide your investments equally across 3 different kinds of funds, which helps reduce that concentration risk we just talked about. So 1/3 goes to a steady, broad market fund. That's your backbone. 1/3 goes to a growth-focused fund. And 1/3 goes to a dividend fund for income. And of course, you still keep that 10% in cash. And here's what that might look like in a real world. Your backbone could be something like VTI. For your growth bucket, you might look at an ETF like QQQM. And for dividends, a really popular choice is SCHD. See, this gives you exposure to totally different parts of the market, all working together in one portfolio. This portfolio is perfect for the balancer. This is someone who wants a little bit of everything, some growth, some income, and some stability without going all in on any one single strategy. It's a portfolio that's really designed to help you sleep better at night because you know you're not overexposed to any one part of the market. And finally, we get to the portfolio that made Maverick's eyes light up. This one is for the investor who wants to be a little more hands-on.
This is the core and satellite model. 70% of your money forms the core. That's your stable base of diversified ETFs. But then 20% is allocated to a satellite. This is a smaller part of your portfolio where you can be more active, maybe try out different strategies. A really popular one is generating extra income from stocks you already own, using something called covered calls.
So what on earth is a covered call? Okay, think of it like this. You own at least 100 shares of a stock. You then sell someone the option to buy those shares from you at a higher price in the future. Just for selling them that option, they pay you a small fee right now, which is called a premium. Now, your shares might get sold later, or they might not, but here's the key. You get to keep that premium payment no matter what happens. It's a way to earn a little extra cash from the stocks you already have.
And who is this for? This is for the tinkerer, the person who actually enjoys being active in their portfolio, who likes making decisions and taking calculated risks for a potential reward. This is the strategy that finally clicked with Maverick's personality. It gave him a place to take action and feel truly engaged with his investments.
So we've just walked through 3 very different approaches. We have the purist, the balancer, and the tinkerer. The big question now is, which one are you? All right, let's recap real quick. If you absolutely crave simplicity and a hands-off approach, set and forget is probably your go-to. If you want broad diversification so you can sleep well at night, the 3 buckets model is a fantastic fit. And if you're like Maverick and you want to be more active and generate potential income, the core and satellite approach might be perfect for you. Because at the end of the day, there is no single best portfolio. The best one is the one that makes sense to you. It's the one that fits your personality so well that you can actually stick with it consistently through all the market's ups and downs without getting distracted by the next shiny thing. So, I'm going to leave you with this one question. Take a hard look at your own investments or the plan you're thinking about building. It's so much more than just numbers and tickers on a screen. It really is a reflection of who you are. So, what does your portfolio say about you?